Hello, this is Brian Shannon from AlphaTrends.net. Today is Friday, the 11th of April, 2008. The market's closed, and welcome to earnings season during a bear market. The S&P 500 finished with a loss of about 2% here today, down $2.74. Obviously, the big news was General Electric. General Electric reported earnings. The stock got smashed. And for the value hunters who came in and bought it on the open thinking it was down too much, you can see that the stock initially did experience a little bit of a bounce, but the sellers took back control of it about 10:45 or almost 11 o'clock Eastern, and it stayed below that declining VWAP all day, trapping in more longs in a losing position in a losing stock, and a stock that's really done nothing for the last 2-3 years. So the S&P 500, yesterday we saw that it was looking like maybe it was showing some signs of recovery as it tried to get back above this 137 level, and I was looking for maybe a right shoulder to be built, and then it could break out past that 137 level. Obviously that never occurred. We had the gap this morning. Instead, it took this market down to a lower low to complement these recent lower highs and lower lows, and the path of least resistance continues to be lower in the intermediate term for the S&P 500. We saw that, you know, we were cautious earlier in the week as we started to see this pattern of late day weakness last Friday and then again on Monday. Then we saw Tuesday, we saw selling, we saw come into this market lower highs and lower lows. Yesterday the market tried to recover, couldn't get above that 137 level, and today obviously we just continued to sell off all day as the broken dreams of a lot of people who thought that the market was in rally mode, came to liquidate their holdings in here today. And that's just the tough nature of the market during an overall bearish environment. When you look at the weekly time frame, we see these signs that the market's starting to recover on a daily time frame. But until we can really make it past some key levels of resistance, and in particular 139.5 to 140, and we start to see a flattening of a 200-day moving average, and some of the longer-term picture really start to look more bullish, you've got to just continue to be very defensive, in particular when we have these big catalysts such as earnings reports. And next week we have a lot of earnings reports due out. I'm going to spend some time this weekend looking for more potential disasters to buy some cheap puts in, and hopefully they can just implode the way GE did. And you can see options that trade at 50 cents turn into $5 overnight. I may post some of those ideas on my blog, but they're highly speculative, so be careful if you do decide that that's something you're interested in. So here we have this market that, we can look at potential levels of support, and as I said earlier in the week, that's all we had right here at this 136 level was a potential level of support. Just because we draw these lines doesn't mean the market will hold up or has to hold into, the structure that we place upon them. Instead, the market's going to do what it does and follow the path of least resistance. The average price since January 1st, I'm going to draw that line straight in across now, and you can see that 135 level, that's the average price the S&P has closed at since the beginning of this year. And it means that, once again, the sellers are really back in control of this market. Obviously, they've been in control on a percentage basis, but there's been a hard-fought battle in near that 135 level. By the way, I was looking at Garmin, and just trying to look at, buy and hold, the logic of buy and hold. In my opinion is there's no good stocks. There's only good trades. If you go back to even 2001, it says 2000 up here, but that's 2001. If we go straight across and draw a VWAP line in here, I let go of it by accident, but in Garmin, you can see that the average price since January of 2001 is at about $50 a share. So while the stock had a great year last year, you got to have a strategy for taking profits, because here now we have 7 years of accumulated losses on average. Now, of course, there's a lot of people that bought down here that are still holding, but if they don't have an exit strategy, it's going to be, they have the potential of letting those profits slip away as well. Enough of Garmin. That's just, one of the many disasters out there. The Russell 2000, again, the key level for this market is the 73 level. This market is going to have a tough time with that, I think, for quite a while in here. We've been seeing some signs of potential bottoming in here, And it's still way too early to call this level a bottom. The bottom is a process. It's not an event. Maybe we go back down there again. It'll catch a lot of people off guard, and I think that a lot of people are just starting to get really frustrated with this market and close to just kind of throwing in the towel. And I think that's being represented by the average volume in here. Just the fact that volume has been so low lately, people are just starting to not care about it. It's starting to get warm outside, and people are thinking of, selling May and go away here real soon too. So you've got to just listen to the message of the market, and only price pays. We've seen that this market here the last week has been trapped under this declining 5-day moving average. We've got lower highs and lower lows. We get these little recoveries that get people, and myself too. I get hopeful that maybe it'll turn around, but you have to listen to price. You got to put your emotions to the side and listen to the message of the market. Hope doesn't pay. Only price pays. Volume doesn't pay. Moving averages, Fibonacci. None of that stuff really matters at the end of the day. The only thing that matters is price. And price continues to broadcast a message to us that there's big problems in this market, in this economy, and we've got a lot of healing that still needs to be done. Now we're back to the middle of the range for this market from basically the beginning of the year. The average price for the Russell 2000 is right around this level here at about $69.50 a share. So the sellers are back in control. Perhaps we're going to see some support form near the $68 level. Again, a lot will depend on earnings next week as well. These semiconductors, man, what a disaster this trade is. Just, it looked like they were breaking past this 30-20 level, and then it looked like a failed breakout as it dropped back down through there on Tuesday and Wednesday of this week. Yesterday, it looked like a recovery, and then today they spit them right back out again. I'm done with the semis for a while. These things need to settle down a bit. And, the old adage, if they don't scare you out on the way down, they will typically wear you out during this back and forth. Get your hopes up and then spit them out, get your hopes up and spit them out. It's just a vicious emotional cycle that you don't have to go through. Just walk away from it. When in doubt, just be out of the market. When the market is sending all these mixed messages, it's saying stay away. Cash is a position. You can't get hurt in cash. You can make 1% or whatever you can, but at least you're not losing money. And a lot of people are losing money by chasing price in here, by getting long one day, getting short the next day, having it get in their face, both directions. It's just a frustrating trade to be in. Don't allow yourself to fall for it. The XLF tried to break past the 50-day moving average and past this longer-term downtrend line. The bottom is a process, not an event. We were looking at maybe shorts getting squeezed above 27.40 or so. Those are potential trade scenarios. They're not the most likely ones, but you need to see, before you get involved on the long side, you need to see these levels of resistance broken. You need to start seeing higher highs and higher lows. We're not seeing that in the financials. The PEs get lower and lower. The PE doesn't matter in here. The dividend yields don't matter. Don't fall for a 3% dividend like I heard them talking about today in General Electric. Who cares if you get paid 3% 1 year from today? Is it worth the agony of holding this stock as it undergoes the accumulation and might heal and go nowhere for another 6 months, 8 months? Who knows? There's just too much uncertainty to get involved. Don't do it. Let amateurs do that. The Nasdaq, the Qs here, this group still looks the best overall, but it's not bullish. The $46 level, we were looking at that as an important level that the market would have to get above and close above. It tried to get above there last Friday and failed. It tried to get above there Monday and failed late in the day. We saw a test of that level again, close to that level yesterday. This market was really looking a lot better yesterday, but today's 2.7% loss obviously completely wiped that out. The market tried to hold above yesterday's lows, but at the end, second half of the session, the sellers came in, pushed this market to a lower low. Now we've got these lower highs and lower lows. We had this uptrend line broken. We saw the potential for support at 45. That was broken. We're back below it again. Now we have the potential for support at 44, but that's not a reason to buy. It's only a reason to study action more carefully on a shorter term time frame, assess risk, see if there is a trade that makes sense. If there is, get in and determine where you're going to get out if you're wrong, because these things can just keep imploding, and the path of least resistance on the weekly time frame continues to be lower.